Time for Under 30, and today we are discussing Sunrun, bringing in the reinforcements. George Tillis is here, senior markets correspondent for the Schwab Network, to discuss Sunrun, stock ticker RUN for those not familiar with it. Catching an upgrade this morning from Citi to buy. George, what's the latest?
Well, I think if you look at the upgrade from Citi, it's really effectively looking at a potential reversal in the industry group, particularly Sunrun, which has been underperforming some of the other bigger players out there, particularly First Solar. I mean, if you look at Sunrun in the past 52 weeks, it's down about 50%, and even in the last 3 years, down about 72%. Now, if you look at their call, they're actually moving their price target down to $21.24, but they're increasing their rating on the stock from neutral high risk to buy high risk. But I think the key phrase in that upgrade is high risk. And I think that's still the case here for Sunrun, which has actually not demonstrated very good performance at all, particularly in the last 52 weeks. I think the entire group got a huge lift from the Inflation Reduction Act, which was essentially chock full of earmarks that actually went to alternative energy companies. It went into companies, not just solar and alternative energy that is associated with EV, but charging stations and anything that has to do with renewable energy's got a lot of tax credits. And I think that's one of the reasons why going into late last year, Sunrun made a little bit of a move to the upside. But subsequently, I think that that tax credit has been played out. And I think that's one of the reasons why the stock has been down in the last year. Now, looking at it, if you consider, what's happening financially for the business, the sales of the business about $2.4 billion, but, last year they lost a pretty significant amount, about $720 million in operating losses, and they're not expected to earn many in the next 4 quarters. But I think one of the things that Citi is doing here by increasing their target, not the target price, but the rating, is I think, and I talked about this in the Morning Trade Live in the past week or so, coming up at the end of September, we are going to have budget renegotiations. And if that is going to play out where there's going to be some pacification on both sides of the aisle, renewable energy companies may end up getting another subsidy. And so with that said, that's maybe why there's a potential here for Sunrun and the other solar names as well. But I do stress that, you can't find the bottom in stocks like this by just picking and choosing, even with an analyst call. The trend is still obviously to the downside, and you don't want to fight the trend.
Absolutely, George. As I look at this, it's pretty well defined here on this chart, below the 50-day moving average, below the 200-day moving average. Sunrun looks a little bit more like slip, stumble, trip and fall, right, than RUN at this point. But you also mentioned FSLR, and I looked here again. You can see the difference in the two charts. Talk to us if the Inflation Reduction Act doesn't excite investors' confidence here and enthusiasm to, shares of RUN. You mentioned some of the measures that we could see coming in terms of regulatory or potential measures on behalf of Congress and decisions made there. But what do we look for to get investors excited about this name, to turn things around basically here, George?
Well, I think I see, at least in the short term, assuming all else equal, there is some sort of positive impact from a tax credit or subsidies provision in next year's budget. And if that is starting to become allocated, because basically fiscal Q1 from a federal standpoint is Q4 of the calendar year, that actually might present an opportunity for investors in the group. And if you look at Sunrun, considering its market capitalization around $3.3 billion, it has about $600 million in cash. So, the cash position relative to the market cap is rather large. But the challenge is also for this name, and I think this is why it's been underperforming First Solar, it's not necessarily based on top-line sales growth. It really comes down to adjusted earnings. And the challenge, I think, for Sunrun as a business is, one, they're selling into a commoditized space, which is solar panels, and two, they have a lot of debt. They have about $9.1 billion in debt, which is 3 times its equity. That's quite large. And I think that, again, that balance sheet strain is causing a problem, especially when operating losses still exist. You have those two variables going against you. Mm-hmm. But, you can see a really magnified turn if all of a sudden they get some provisions, subsidies, tax credits, you name it, in the upcoming budget renegotiations. you could see the adjusted losses shrink quite a bit in at least the next 2 quarters. And with that said, you could see a price reverse to the upside, especially, and I talked about this quite often with Alex and Jenny and everyone, the companies that have a lot of debt, once there's a turnaround, especially in the commodity space, you can actually see the price magnify higher, very quickly in equity. And that could be the case here for Sunrun. So what I'm saying is that in the short term, if there is some positive provisions for the industry, you may see Sunrun outperform some of the other respective larger peers like SunPower or First Solar because it has a lot of debt. I know it sounds counterintuitive, but that's the gearing nature of equity relative to improving financial conditions for debt.
Yeah, and the kindling for that move could also be the fact that it has almost 18% short interest as well. If something drastically changes, that could, accelerate that upside move. But, George, not to throw cold water on this, but to keep it balanced, if that stuff you're talking about doesn't happen on a fiscal basis, I'm seeing a company with 12,400 employees as of the end of 2022 and a stock price that seemingly is only going in one direction. That, to me, we're looking for ways that this labor market's going to crack. There's a lot of these companies, George, that this doesn't seem sustainable if things don't turn around. Final thoughts here, 30 seconds or so before we say goodbye.
Yeah, I think it's a very labor-intensive business. I think that's a challenge from the standpoint of operating expenses. And if there's no provisions, I think you just don't want to fight the trend. The stock is trending below its 10 and 20-week moving average, even Ben alluded to the 50-week moving average. So until it crosses, at the very least, the 10, there's nothing here to be said from an investment standpoint.
Good stuff. George Tillis, Senior Markets Correspondent for the Schwab Network. Always a pleasure.